In May 2022, 40 billion in wealth evaporated in 72 hours, not in a slow bleed, not in a market correction, in 3 days. And now a new lawsuit is pointing fingers at one of the most secretive and prestigious and sophisticated trading firms in the world. They're called Jane Street. They have an office on Wall Street and Hong Kong and other parts of the world. What's the allegation? That they had information the market didn't, and they used it. But here's what no one is talking about. Even if they did, it may not have been illegal, or was it? Because the system that was supposed to prevent exactly this, it didn't exist. Today we're going to break down the lawsuit, the collapse, the stablecoin yield problem, and why a single piece of legislation may determine the next decade of digital asset wealth. So stay with me because there are three things in this story that most investors are getting completely wrong. I'll reveal the first one in 2 minutes, okay? And remember that this is for educational purposes only. Make sure to do your own research before you take any investment actions. This is not financial, tax, or legal advice. All right. Make sure to like, share, subscribe, and comment if you have any questions. So let's start with what we actually know. The bankruptcy estate of Terraform Labs has filed a civil lawsuit in Manhattan federal court against Jane Street Group, alleging that the firm used strategic liquidity positioning methods, right, to cause the catastrophe back in 2022. Before we go further, let's be precise about that. So, three things that the lawsuit is a civil allegation for bankrupt state, a legal argument, not necessarily a proven fact, a window into market structure failure, and the three things that it is not a criminal conviction yet. It's not a regulatory enforcement action yet. And evidence of illegal conduct, not yet either. All right. So Jane Street denies the claims. They're one of the most sophisticated market participants on the planet. They don't make careless mistakes. But the deeper question isn't whether they broke the law. The question is, was there even a law to break? All right. So let's discuss that. So in a fully regulated market, what Jane Street lately did would have clear legal consequences, but crypto isn't fully regulated like that. So that's the issue. So in traditional finance, if something like this happens, right, they have all these laws. If Goldman Sachs desk had a material on public information on a stock and trade ahead of a collapse, they'll be in big trouble. That's a federal crime. In DeFi, decentralized finance, that's not necessarily right. It's nothing, right? So that's not necessarily manipulation, but it is a regulatory vacuum, and vacuums get filled and by innovation or by exploitation. So let's talk about the next part there, right? Let's talk about the stablecoin yields. Now here's where it gets complicated for every digital asset investor watching this. Terra ecosystem wasn't just a stablecoin; it was a stablecoin that paid yield. Terra USD was offering up to 20% annual return. Think about that, 20% on something called a stablecoin. That's not saving account territory. That's not even junk bond territory. That's something either wrong or something's about to go wrong territory. The moment you add a yield to a stablecoin, you've created a hybrid instrument that doesn't fit neatly into any existing regulatory box. A payment instrument, all right, is handled by banking regulators, commodity handled by CFTC, an investment contract handled by the SEC. And that jurisdictional question, who owns the asset class, is precisely why we've had years of regulatory paralysis in Washington. Brian Armstrong at Coinbase and Ripple's CEO have been some of the voices calling for regulatory clarity. And when the two sides both want clarity but disagree on what clarity means, you don't get a framework. You get enforcement actions. You get losses. You get 40 billion evaporated in 3 days while Congress debates jurisdiction. So is your stablecoin actually stable? I'll explain exactly how the FIT 21 Act is trying to solve this jurisdictional war and why the answer to that question will determine which digital assets survive the next decade. that's coming in the next part. Okay, so now let's discuss that. So here's what I want you to understand, and this is the thing most retail investors completely miss. The Jane Street lawsuit isn't really about Jane Street. Terra's collapse wasn't really about one algorithm stablecoin, right? These are symptoms of a much larger structural problem. Digital asset market evolved, right? The digital assets market evolved at the speed of code. Regulatory frameworks evolve at the speed of commerce. That gap between market innovation and legal infrastructure is where billions of dollars get lost. Traditional equity markets. ATS governs alternative trading systems. EAT guides the consolidated audit trail, tracks all orders. Insider trading law has 60 years of precedent. Liquidity withdrawal at scale trigger reported. Liquidity pools can drain in minutes. Governance decision move prices with zero disclosure. Material non-public information has no legal definition. Smart contracts code is public, but intent is invisible. This is why financial innovation and FIT21 matters so much. The bill's core mission is deceptively simple. Find when a digital asset is a security and when it's a commodity. Assign clear oversight. Build an infrastructure that prevents the next Terra level collapse. But here's the political reality. Every major financial regulator has a seat at this table, and none of them want to give up jurisdiction. The SEC wants securities authority over crypto. The FCFTC wants commodity authority, and the banking sector is watching both of them, worried about stablecoin issuers eating into the deposit. This isn't just financial regulation, it's a power struggle between agencies, between parties, and between the old financial system and the new one that's already processing trillions in volume. So now let's go further. In this final section that I want to talk about, I'll connect all of this directly to your portfolio, specifically what regulator, all right, what regulatory clarity or lack of it means for which assets appreciate, which platforms survive, and where institutional capital flows. So let's talk about the incentive power, right? The incentive power and who it. So let's zoom out and look at this like a strategist, not a speculator. Every major player in the story has different incentives, and understanding those incentives tells you more about where this goes than any price chart. Exchanges want regulatory certainty, not because they love regulation, but because certainty attracts institutional capital. BlackRock doesn't allocate billions to an asset class where the legal ground shifts under their feet. Market makers, firms like Jane Street, they want flexibility, liquidity, environments with predictable compliance, boundaries. They can operate in regulated markets. What they can't operate in is retroactive enforcement where the rules get written after the trade. Regulators want consumer protection and jurisdictional authority. Those two things aren't always compatible, but they're both on the table. And lawmakers, they want innovation headlines without collapse headlines. They want to be the party that didn't let China win the crypto race. They also want to be the party that didn't let 40 billion evaporate on retail investors. When incentives collide in legal gray zone, the result is instability, right? It's selective enforcement, and selective enforcement creates volatility, both financial and legal, that destroys wealth at every level of the market. What this means for your portfolio is this. Here's just a strategic takeaway of every wealth builder watching this. Market structure maturity is a wealth multiplier. When regulatory frameworks solidify, institutional allocation increases, volatility compresses, capital inflow stabilizes, assets that survive the transition become foundational holdings. The Bitcoin ETF approval wasn't just a headline. They were evidence of market structure maturing, the movement. You had BlackRock, Fidelity, and Invesco in the market. The rules, right, of the game change. Stablecoin legislation, if it passes, it's the same thing for 150 billion market. It doesn't eliminate risk, but it redefines who the counterparties are, what disclosure exists, and what protection are in place. The Terra collapse erased 40 billion because there was no infrastructure because to prevent it, slow it, or even flag it in real time. The next generation of digital asset infrastructure is being built to prevent exactly that. So, three questions every investor should be asking right now is which asset will be classified as securities and therefore face the most regulatory friction? Which platforms have the compliance infrastructure to survive institutional grade scrutiny? Where does capital consolidate when the gray zone disappears? Because those answers don't just determine the return, they determine whether you're positioned early or picking up the pieces after someone else. So before we go, I want to say one last thing. The question was never, did Jane Street manipulate the crypto market? The real question is, was there a system capable of defining manipulation? And until Congress draws those lines with the Market Structure Clarity Act, markets will keep pricing in regulatory uncertainty. And that uncertainty will keep transferring wealth from those who don't understand structure to those who do. At Empower Capital, we don't chase cycles. We study structure because structure determines survival. If this breakdown gave you clarity, subscribe and watch the next episode. We break down exactly how to position your portfolio before the next regulatory shift. Take care. We love you. God loves you. Stay blessed. All right. And we're doing this for you because we want to give back to you. All right. Thank you.